Hey guys, welcome to today's video. So on this video, I'm going to give you a detailed breakdown of India's stock market opportunities, right? I'm going to go at sector level. I'm going to do Nifty analysis. I'm going to do sector analysis. We'll talk about some stocks. Now, this is not just a fluff video where I just come and speak stuff. I'm someone who literally puts a lot of capital behind his bet. For example, this is a bet that I took. It was roughly $1 million, which I invested in Nifty 50. Just before Diwali, it has started to go up quite aggressively. I'll be cutting positions here, building positions elsewhere. So I'll help you understand the practical things. Okay, so let's jump right into this teaching video. And my simple request is that one, please like this video so that more detailed teaching oriented practical videos reach you. Second is that please watch this video till the very end. If you don't have the time, don't watch it. This is a serious learning video, money making video. Okay, so let's begin. And first things first. If you take a look at Nifty 50, it has made an all-time high. Now here you can see that this is Nifty all-time high and the previous high was this one. It was 26,200. Now we are at 26,344, somewhere around that. So Nifty has made an all-time high. Nifty 50 is meaning that this is the collection of top 50 companies in India. These have made an all-time high. However, many of you have been complaining that, okay, our portfolios are not growing, this, that stuff. Now, why is that happening? So for that, you need to go to, let's say, mid-cap 150 or small-cap 250 because mid-cap and small-cap companies work very differently compared to Nifty 50, okay? So let's look at mid-cap 150. So here you would see that Nifty 150 hasn't made its all-time high. It is trading at roughly 22,432 and the previous high was also 22,478, so around that time. And within this phase, what has happened is that a lot of stocks have corrected. Okay, so from here to here. And this is a significant drawdown that has happened on mid-cap stocks. And this drawdown was roughly 22-23%. So 1.25 years have happened and mid-cap 150 has just done like a 25% downswing and people have not made any money on it. Small cap, even worse, right? Small cap, people are still losing money. So let's look at small cap 250. And here you will see that this is going through a valuation correction. So this is a clear valuation correction pattern, right? What is there? And some kind of triangular pattern might happen. So I'll just explain that in a minute. What is the meaning of triangular pattern? So this is something that might happen here on small cap 150. That small cap ran from here to here. Okay, this was a very big run up. Since then, it has just gone in this channel, okay, and then it will consolidate and then it will break out, right? Something like this might happen. But right now it is going through something called as valuation correction, right? Now, why is it going through valuation correction? If you understand this story of small cap 250, you'll be able to relate a lot to whatever is happening right now in the market and what is likely to happen in the next 1 to 2 years. So, okay, very quick point here that just if you look at the last maybe 3-year history of small cap 250, a lot of interesting data will come up, okay? So for example, from here to here, this is April 23, okay? And from April 23 till September 24. So within a year and a half, small cap 250 ran by 125%. Now this is unreal returns, okay? And I also made a lot of money. My community also made a lot of money and we exited. We exited somewhere around here and small cap 250 ran a little bit more. So I booked around like 100% profits on whatever investments I have made on small cap and mid cap 150s. Now, the reason why I did that was that at this point, right? I mean, any point above this, the valuations had gone out for a toss. So valuations were very high. Now, India, or especially in India, you have to be very mindful of valuations. Now, there might be great companies. For example, if you consider something like Zomato right now. Now, I have personally put money in Zomato, made a lot of returns, but I have exited the stock. Now, this is not a recommendation that you exit, don't exit, do whatever you like, okay? But what I'm trying to explain it to you is that Zomato's PE valuation is more than 1250, not 250, 1250 ke PE pe chal raha hai Zomato ka stock, okay? Now, what needs to happen here is that the earnings of Zomato has to grow really, really fast. Even a 30% earning might not stabilize the stock. Even then the PE will be fairly high. Even if Zomato goes 10x from its current profit, then also its PE will only fall to 125. That is still a fairly high PE, okay? Long story short, what I'm trying to tell you is that in India, what typically happens is that if this is the benchmark or index that you're talking about, there will be periods of massive euphoria that, for example, this happened on small cap 250, that within a year, right, there was a 125% return, okay? And then there was a massive slump and dump, right? And then it started going something like this. Now, if you study this at an individual stock level also, something similar had happened. For example, let's study Trent stock. Now, Trent was a company where there was a lot of euphoria. And how much has the stock corrected from its peak? Almost 50%. What about Tata Motors, right? So I had made video also that, don't put crazy amount of money on Tata Motors. Good chance that it will correct, because you need to understand or at least have a basic sense of valuation of companies in which or assets in which you are putting your money. Okay, so let me just quickly show you Tata Motors once, right, and then I will do more commentary. So here is Tata Motors stock, right? It used to be at 615, now almost aadha ho chuka hai, right? And still it's not reviving, so to say. Now what is happening here is, again, the phenomena that I was telling you about, that there are phases in the Indian market when things are seriously pumped up, okay? And then when dumping happens, you get stuck with those assets for 4, 5 years, right? This has been common, right? For example, let me show you like ITC phase, right? So ITC stock. Now here is ITC. Again, I made money on ITC. Go and watch my 2021, 2022 type videos, right? I was buying ITC at that point in time and I made some money and then I exited the stock. But what is happening is that since 2023, ITC has gone sideways, right? It has not made any money. Now go and look at the history of ITC. Again, you will find this happening, that between 2012 and let's say 2022, so 10 years, ITC investors made no returns. Key takeaway that I will give you is that, see, in Indian market, you have to be very asset specific and valuation specific. Because if you buy great companies, even at very high valuations, you will get stuck. For example, there is nothing wrong, fundamentally speaking, on ITC stock or Tata Motors stock. All are good companies. Similarly, nothing wrong with Zomato. But if you are expecting that at 1300 PE, the company will continue to deliver like 30% stock growth, then you have to recheck your expectations. Now, I'm not saying I'll 100% be correct on Zomato's bet. I'm taking antithesis on Zomato here, but I'm just helping you understand the logic. Now, the logic can be off. Okay, so yeah, everyone can make a bet as per their logic, but for me, Zomato now looks very expensive. I'm not touching it. Okay, I hope that this first point is clear, that what is happening in the Indian market. Is Indian market structurally bad? No. Okay, no problem. Is Indian market structurally good? No, right? You have to be very, very segment stock specific. Now, let me take you to a quick presentation that will help you consolidate this thesis and antithesis so that you understand both sides of the equation. So, okay, so let me quickly share my presentation with you, right? And just share a few key points that what is some bad stuff happening in the Indian market. Data can be checked on this. So there are 5 key problems that Indian market is facing. If you understand these 5 points, then you can filter out your companies better. Now, in case you need more help in terms of filtering out companies, in terms of understanding all these data points, in terms of understanding deeper details about certain companies, etc., then I do a lot of investment-oriented commentary. You can check out the links in the description comment box. So, okay, 5 key problems, and the first key problem is that FIIs are heading out and they are not coming back. Now, I am an NRI myself, right? And I can tell you that there is less benefits for an NRI to invest in the Indian economy. Now, many of you will get pissed off. Many of you will say that, aise kaise bol diya aapne, India 8.5% growth rate, this, that stuff, very strong economy, fastest emerging market in the world, vagera baatein. Bhai, see, those are great headlines. Okay, I'm not debating you on this. There is no point in us debating about this topic. Point is that when foreign investors come, they are making an investment. They need to see returns in dollar terms. Now, what ends up happening is that because INR constantly keeps on falling, right? And this is a topic that I have discussed extensively on my Twitter and bunch of other places, that because INR keeps on falling, right? To a foreign investor, this becomes a huge problem. Now, this is a problem even for domestic investors, but it hurts them less. So let me take a minute to explain this. See, what ends up happening is that, let's say that, if there is a US based foreign investors, okay, and he invests in the Indian market at 80 rupees, right? And then he's able to make like 12% CAGR. Now, he does this exercise for 5 years, right? But on a 5-year basis, if INR keeps on depreciating by 4% per year, is his real return 12%? The answer is no. His real return will be 12% minus 4%. equal to 8%. So it becomes 8%. So the headline is telling a foreign investor that, see boss, if you come to the Indian market, you will make like 12% CAGR, 13% CAGR. But if you adjust it for the fall of INR, and here you can take a look that at what rate INR has been falling in context of dollars. So if you adjust for that INR fall, then the real return for a foreign investor remains only 7-8%. Now this is not enough return for the type of risk a foreign investor takes on an emerging economy. If he or she wants to make only like 7-8% dollar returns, they are for fair, they will stay in the US only or go to Europe or go to some other country, right? And वहाँ पे भी मिल जाएगा उन्हें like 5-6% dollar return and all that by taking lesser risk. So this is the reason why FIIs are out. Now some of you will get pissed off. Some of you would say that no, this is not true. FIIs are investing big money. See, it's the net amount of money that they end up investing in the Indian market. Here is FII DIA data. आप खुद ही check कर लो, right? There is no point in me trying to tell you other details, right? So here is the data. You go month-wise, right? Here is the entire data. I will leave the link in description comment box. You can go and check it out yourself. So here, what you would notice is that all these red figures, right? This is where FIIs are selling. So this is FII data. Okay, so just scroll through it. You yourself see that generally what the pattern is like from 2020. So generally, FIIs have been net sellers in the Indian market. This trend hasn't changed. Natural question comes that will this trend change anytime soon? It doesn't look like it, okay? Because as foreign investors, they look for better markets or risk-adjusted returns. Now, in Indian market, when will that risk-adjusted return kind of make sense? Well, when our market is deeply undervalued. So, which brings us to the second reason why Indian market is in a kind of a turmoil and danger zone right now. It's because the fact that Indian market is not discounted yet, even despite Nifty doing okay now and all that stuff. Now, why am I telling you this? So for this, just study this chart, and this is Warren Buffett's ratio. This is a ratio that Mr. Warren Buffett has made popular, and this talks about the total market cap of Indian companies in context to their GDP plus the total asset size of central banks. Okay. Now, basically, Warren Buffett indicator says that, see, you have like Nifty 50 companies, right? There are 50 companies. Now, if you take the market cap of these 50 companies, this market cap should exist in a certain ratio which aligns with the GDP, okay? Because it should not be the case that market cap of the companies have gone up dramatically. That market cap has gone up by, let's say, a CAGR of 40%, okay? But GDP is only growing at a CAGR of 20%. What would that indicate? Well, it would simply indicate that the stock price rise has been faster than the real economic output, okay? So this is what Warren Buffett indicator in very simple language means, that stocks prices are growing very high, but the fundamentals of a company, which kind of makes up the GDP, right? Because if you look at what the GDP is, GDP की definition होती है that this is the sum total of all goods and services produced within an economy. Now, who produces these services and goods in the economy? Well, these are companies like TCS, Infosys, all these companies. So then there has to be a correlation between GDP and market cap of the stock. So long story short, if you study this ratio, which is called as the total market cap to GDP ratio, what you will figure out right now as of 25/11/30, so this is 30th November 2025, that the ratio is at 144. This is significantly overvalued. Okay, and this data is for TMC, which is the total market cap. Okay, so this is not just Nifty 50 companies. This might be Nifty 500, right, which is the broad-based index for India. So this is the equation. Now, then what we need to do is that, yeah, by this ratio, we should never invest only. No, that's not the point. The point is that there are pockets of undervaluation, fair valuation, and overvaluation. This is where you should spend majority of your time as investor in terms of investigating. What is it that is overvalued, undervalued, and fairly valued? Now, in order to understand valuation, you need to first and foremost study macroeconomics and have a sense around it. Okay. For example, it is quite obvious at this stage that interest rate cuts will happen, right? Why? Because our growth rate has been slow. Now, many of you would say that GDP growth rate has been really high, this, that stuff. See, a lot of questions are being asked on the data. A lot of prominent economists in India are saying that these GDP numbers do not add up. There is at least a 45% kind of disparity between what the actual GDP truly is on the ground versus what is being projected in the data format. Now, this is a political issue, so I'll stay away from it. But basically, RBI right now is focusing on growth rate because they need to accelerate the growth rate. And right now, the interest rates in India are moderate. They are not very low. They are not very high. So going forward, RBI is going to cut interest rates. Now, if in such a situation, you see some opportunities, for example, a lot of NBFCs, okay, might benefit, or a lot of retail lending companies might benefit, okay. What is the other macro thing that you're witnessing in the market? Well, one very clear thing is that the Indian government kind of banned Dream 11 and all these fantasy gaming app or whatever you call. They have been calling FNO some kind of poison, toxic, this, that stuff. So what is the effort, right? I mean, if you step back and try to look at the big picture, what is the effort that Indian government is leading? Well, they are thinking that, you know what, people should not put in crazy amount of money into these fantasy apps, into these FNO activities or speculative activities. Rather, put this money in terms of consumption, put this money in terms of growth, okay, which is right, which kind of makes sense, no doubt about that. Speculative activities should be curtailed, I'm not denying that. But what's the macro move? Well, the macro move is that companies like NBFC, retail lending, they can actually benefit from this move because banks end up getting more money, right? And if banks are getting good amount of money because people are spending less on futures and options, people are doing less of this, so they kahan jayega paisa, right? Mutual fund mein jayega, stocks mein jayega, FDs and all that stuff. Banks will lend to these companies. So a lot of stocks, for example, there's a company called as Aavas, which you can go and study. Now, I'm not issuing like buy, sell or any of that thing. I'm just simply telling you that go and study. If you like it, then probably it could be an opportunity. So you can look at that. Third key point, that INR has been falling like this, okay, literally like it has been falling like aggressively. Now, at some stage, it will stabilize, okay. So this is like a good thing that what will happen in the Indian economy. GDP data, at least on headline number, has come out to be positive. So at least our domestic flow or domestic institutional investing will continue to drive things up, right, which is a good kind of a thing. Fifth and final point, see, this is a very big thing that a lot of IPOs have come. They have to survive for the next 6 months at least, right? वरना वो तो pump and dump हो जाता है, right? ये ऊपर गया, right? IPO निकला and then it fell. Okay, so that should not happen. So here IPO market is still underway. A lot of other big ticket companies, boat and whatever, they also need to IPO. उनको भी अपने पैसे बनाने हैं. So because the IPO market needs to stay afloat, even the Indian market has to stabilize at this point. So long story short, the summary statement that I will tell you is that there are a lot of good tailwinds for the Indian market. There are challenges. But long story short, what you need to think is that the first step in terms of figuring out undervaluation, fair or overvaluation is that you look at the macro environment, okay? So these are some positive points that are happening. Now, what are some of the negative points that are happening? I'll just give you a quick snippet or summary there. So that will give the full picture and accordingly you can take a macro bet, okay? And I'll talk about some of the macro bets that I might make. So first key thing, that FIIs are still out of the Indian market. They are unlikely to return. The risk-adjusted reward do not make sense. When will risk-adjusted reward make sense? When the valuations, let's say for Nifty 50 or small cap 250 or mid cap 150 goes down. Okay, the valuations are sensible. We are at best, right? Even if you are highly optimistic, you can say that, hey, Nifty 50, mid cap 150, small cap 250, you can say that it is at best slightly overvalued. Okay, worst case scenario, it is deeply overvalued. Okay, so right now there is no comfort level for foreign investors to take all that risk, bet on the fact that okay, INR will improve or stabilize in a short term. So if someone is a foreign investor, it does not make sense for them to put in a lot of money in India. Okay, this is a genuine opinion. This is a genuine data-backed analysis that I'm doing. Okay, so valuations are still rich as I have analyzed by using the total market cap to GDP ratio. Third, the earnings improvement in the Indian market is very, very average. Now here we have gone through a consumption cycle. Now consumption cycle, what I mean is, and I'll show you like a quick chart here, right, what it means. So see, if you study like the years 2020, 2021, right, 2022 and even 2023, government expenditure was very, very high. Why? Because 2024 was an election year, 2020 was COVID, 2021 were low interest rate environment, etc, etc. So at least like 3 years, government did very heavy spending. Now this is government expenditure, that because government is spending, our GDP goes up. Okay. Now this government spending should lead to something called as gross fixed capital formation. Okay. This simply means that the government has created productive infrastructure which is creating more jobs. For example, if government builds good quality hospitals, if the government builds good quality educational institutes, if the government builds high quality roads which are not getting washed out after every monsoon, what does that lead to? Well, it leads to more transport. It leads to more logistics driving through the roads, people getting more education, people getting more healthcare, doctors getting jobs, वगैरह वगैरह बात है. More investments coming that, okay, people will see that, okay, हाँ यार, high quality stuff बन रहा है. I'll also set up a shop here or whatever, right? So this is called as gross fixed capital formation, that government spends a lot of money that leads to gross fixed capital formation, which leads to more jobs leads to more consumption leads to GDP increase. Why? Because our GDP increases primarily due to two things. One is because of government spending and second is private consumption. And almost 60% of our GDP comes through what? Through consumption or private consumption. Okay, this is very big. Now, unfortunately, what has happened is that in India, this wheel has been broken. Okay, government undertook a lot of expenses in 2020, in 2021, in 2023, right? So these 3 years especially. But unfortunately, our gross fixed capital formation was very poor. Multiple studies prove it. As a result, job creation had been really poor. Now, on top of this, if there are high taxes, capital gains and vagara taxes, it just derails the entire engine. So as a result, what happened is that we saw contraction of volume growth in India and contraction of profit growth for companies. So these are two challenges that India is still facing. And Indian companies or listed companies are still facing. So we are in a phase right now that this year basically, there were like budget announcements that, okay, income tax kam kar diya, good reforms on GST and everything. So first, volume growth should come, right? And this has started to happen in the Indian economy. And then profit growth will come, because for us investors, we need to be worried about earnings of the company. And this is the reason why I say that we are still like maybe a year out, year and a half out if things go well, where you will see serious earnings growth in Indian companies. And that is where you and I, as stock investors in the Indian economy, will benefit from. Okay, so this is an unbiased analysis. This is where we stand currently. So I've shown you positive picture, negative picture, both. Now your call, how you want to judge the valuation. Now what I will leave you with is that before starting out like with very specific examples, I'll leave you with 5 investment strategies that I'm personally adopting, and I will help you understand some examples around it. So first is that I will trade in this market. Now I had taken a swing trade on Nifty 50 during Diwali, and I had invested close to $1 million, right? And that is up by like around 2.53% within a month. Now this is very good CAGR, right? If I'm able to find maybe even 6-7 such bets in a year, then from a CAGR point of view, this will still be more than 15-16, even if I'm keeping like not the entire capital in the market, I'm locking it in FDs or whatever, okay, temporarily. So this is what I plan to do. I have taken 2 swing trades. One is on Nifty 50, one is on Nifty IT. Both seem to be doing very well, right? And I retain these, right? I've started booking some profits on Nifty 50. I'll rotate it to slightly riskier stocks, okay? This is one. Second is that it's very important to buy undervalued and wait. Now, why am I writing the word wait? Because people get very impatient. Now, let me show you an example of a company called as IEX. Now, when IEX, and let me pull up the chart first. When IEX was running, right, from here to here, it ran like maybe 100% and people were like, monopoly company hai, kabhi nahi dubegi, such a great company, put all the money at top, okay. Now, investing here is absolute madness on any company in India, okay. Then it corrected a lot, right. I picked some positions, then it corrected more, then there was decoupling, I built even more positions. Now, since it has gone sideways and मेरा थोड़ा बहुत loss चल रहा होगा इस पे, it's not as if that, I've been wiped out or anything. This still remains a good company, okay? There is nothing off about the company due to decoupling issue. So this decoupling issue maybe happened like 6 months ago, right? And since then, right, it has gone sideways in this channel, right? So now if you study IEX, at least from a valuation point of view, you don't need to worry too much, okay? You can question the fundamentals of the company that, okay, fundamentally, maybe something is wrong with the company. You can have your opinion, whatever it is. So you start doing fundamental analysis. But valuation wise, the company is fine, right? So if the fundamental analysis tells you that, okay, this is a fine company, then you can go ahead and build some positions. So it kind of makes sense, but you still have to wait here, okay? Same thing happened with IT stocks also, that they underwent a PE correction. Now they have started to go up, okay? So this is very obvious in the Indian market that these type of opportunities keep coming. You just have to buy and wait at reasonable valuation. This is 2. Third key point is that you have to sell overvalued companies and forget about it. Now, why am I saying not chase or forget about it? Because hota kya hai ki, for example, I spoke about Zomato. Now, if you sell it tomorrow, right, and then suddenly it gives like a 5% run up, then you will start worrying, oh no, yeah, chhoot gaya, iski wajah se ho gaya tha, and all that stuff. See, guys, be accountable, okay? If you need more fundamental knowledge, I have different communities you can join. It can really help you out. It can help you become a better investor. But there is no investor in the world who can tell you the exact top or bottom of things, okay? We can just reasonably tell you that, okay, what is overvalued, what is undervalued. And it's not science, it's broad what we can tell you, right? So definitely, according to me, something like Zomato, which is trading at 1250p, 1300p, Lenskart 250p or whatever p it's going on. So with these type of companies, you should be careful, okay? And don't worry about that, okay, I sell it tomorrow and day after tomorrow it starts running, then you start stressing about it. Don't get into that. It's common sense that no one can time the top or the bottom, right? This is 3. Number 4, if you are uncomfortable, for example, one of the key problems in the Indian market right now is that there is not enough growth opportunities. Why is it that companies like Zomato are trading at 1300, 1400p? The reason is that DIIs keep on pumping more money onto it. They have no other option but to buy overvalued company. Zomato is a part of Nifty 50, eternal now. So that is a part of Nifty 50. So automatically, if you're doing index investing, some part of it will go to Zomato. It gets bloated. There are limited growth options in India. Zomato is a great company, great business, right? But the problem is valuations. So in India, if you find a growth company, it really trades at a premium valuation. If you need more options, go global, right? Look at American companies. A lot of small mid-cap companies in the US are trading at a discount. Bunch of other things happening. So this is another strategy that you can use. Point number 5, prepare for a sideways market. Because as I said, that we are not discounted. It might very well happen. Let me take you back to Nifty 50. What might very well happen is that, for example, here we have given a breakout, okay? Now we might trade in this kind of a range, right? Or we might go like this and trade here. Now this is a sideways market, and this is where people get stuck, because if let's say that for another 1 year, Nifty only gives like 10%, then that is below the benchmark, which is 12-13% typically for Nifty. So then the market goes into slightly more discount zone. So that is valuation correction, not from a price point of view, but from a time point of view, that another year happened and not much returns have happened. So as a result, value starts to come. Then earnings improve a little bit. So this is a very big possibility, and this happens in a sideways market, and almost 70% of the time, the market stays sideways. So if I have to bet on the Indian market right now, I would still say that it is going to be slightly bullish to sideways. That's what my understanding would be. We are unlikely to see a 15% plus CAGR, right, at this stage. So I cannot call it like a bull market or something. So this is not going to happen. This is very unlikely. So you need to understand strategies to make income in a sideways market. So for example, selling covered calls is a great strategy of making income from a sideways market. It should be done in certain style with certain proper knowledge. So learn more about it. So these are 4 or 5 things that I wanted to touch upon. I hope it gave you enough context of how to deal with the Indian markets right now. Small cap, mid cap are still kind of overvalued. I would not be touching it, and I have not been touching it for the last 1.5 to 2 years now. Second is that Nifty 50 seems okay, right? It's not deeply undervalued. Foreign investors are unlikely to return in hordes right now, right? That's not going to happen. Good things are coming, right? I think earnings improvement has started to happen volume wise. Now it will happen from a profit wise. So it will translate into better stock prices going forward. But this engine will still take time, right? Maybe like a couple of years. So you need to deal with a sideways market. I hope you enjoyed this video. If you did, do press the like button, and I'll see you soon.